Welcome. Today, we're doing a structured deep dive into the Agricultural Bank of China's third quarter results for 2025, really dissecting the core drivers behind its performance.
So let's begin with our core findings right up front. The analysis confirms the bank is showing some remarkable resilience against what are really sector-wide headwinds. Its main strategic advantages are proving to be very effective, and crucially, some of those key pressure points, like its net interest margin, are showing early signs of starting to stabilize.
Here's how we'll structure our analysis today. We're going to move through 5 sections, starting with the headline Q3 performance, then digging into the strategic foundations that are driving these results, before we wrap up with a forward-looking view on potential risks.
All right, let's jump right into our analysis of the Q3 performance and see exactly how the numbers back up these initial findings. The first critical data point is this, 3.03%. Now, that's the year-to-date net profit growth. In the current environment where the entire banking sector is really feeling the squeeze on profitability, a figure like this, frankly, underscores the bank's resilience.
And this profit growth isn't coming from taking on bad risk. It's actually underpinned by exceptionally strong asset quality. You can see the non-performing loan ratio continued its downward trend, falling to a very low 1.27% by the end of the third quarter. That's a key indicator of a very healthy loan book.
This defensive posture, this fortress balance sheet idea, is confirmed even further by the bank's provision coverage ratio. It stands at an impressive 295%. This represents a substantial capital buffer against any potential credit losses, providing a really significant safety margin.
Now, what's particularly noteworthy in this quarterly data is the divergence in performance. It's really a tale of two income streams. While net interest income faced some predictable headwinds, you can see it contracted by nearly 3%, this was more than offset by a massive surge of over 25% in fee and commission income, and that's what ultimately drove the overall revenue and profit growth. And this leads us directly to the core of Agricultural Bank's unique strategy. It's deep, and I mean really differentiated, focus on what's called county-level or Sanong finance. So Sanong refers to the bank's foundational business in agriculture, rural areas, and with farmers. But look, this is not just some market segment for them. It is their core strategic identity, and it creates a distinct and, frankly, very defensible competitive advantage. The data from the previous full year reveals just a stark contrast. The Sanong business delivered an impressive 21.7% pre-tax profit growth. Meanwhile, the more competitive, more saturated urban business actually saw its profits decline. This really highlights where the bank's true growth engine is. This operational focus creates a really powerful self-reinforcing cycle. You could call it the Sanong flywheel. It all starts with a dominant physical network that gathers these low-cost, very stable deposits. Those deposits then fuel profitable lending in less competitive rural markets. And finally, the profits get reinvested right back into the network, which strengthens its moat and restarts the whole cycle with even greater force. Okay, so while the Sanong moat protects the core lending business, the bank isn't solely relying on it. They've been actively developing a second engine to drive growth, which is absolutely crucial for offsetting these sector-wide pressures. The primary headwind for the entire sector is net interest margin pressure. As policy-driven lending rate adjustments come through, they compress the profitability of those core lending operations. For Agricultural Bank, this metric stood at 1.26% in the third quarter. This chart illustrates the bank's counter-strategy perfectly. The modest 2.4% dip in net interest income was more than compensated for by strong growth in fees and, look at that, a significant surge in other non-interest income, which, just as a reminder, was driven mostly by investment gains. This approach is best described by the strategy of using volume to offset price. What does that really mean? Well, in essence, as the profit margin on each individual loan shrinks because of policy, the bank compensates by deliberately and pretty aggressively expanding the overall size of its loan book. It's leveraging its scale to maintain that earnings growth. Now, this DuPont analysis is crucial for understanding the real performance drivers. Notice that the overall return on equity, the ROE, is down. However, and this is the key point, it's not because of a lack of profitability. The net profit margin is actually up. The real pressure point is that sharp drop in asset turnover, which is a direct consequence of the lower net interest margin we just discussed. So to counteract this, the bank is increasing its financial leverage, as you can see from the rising equity multiplier. So, to maintain a balanced perspective, it's absolutely necessary to analyze the potential risks and headwinds that could challenge this performance as we look forward.
There are 4 key risks here that require careful monitoring. First, sustained margin compression from ongoing policy guidance. Second, latent stress within the real estate portfolio despite the bank's strong overall asset quality. Third, the potential return of geopolitical risk when the current one-year trade truce expires. And finally, of course, the impact of any broader macroeconomic weakness on default rates.
So, this all brings us to the central question stemming from this analysis. The Q3 data clearly confirms the bank's formidable structural strengths and its solid strategic execution. The key uncertainty moving forward, however, the question to watch, is whether these distinct advantages are sufficient to ensure consistent resilience if those macroeconomic pressures continue to intensify.